Hi, welcome to February transaction review and calculator practice. A few of you, most of you have been here before. Welcome, Joe. You're a new member, I think from, gosh, I don't know if you can speak. Some of you have mics and you can speak and some of you can't. So I'm going to try to unmute people. I like it if we can talk. Otherwise, use the chat button or the Q&A, I think it is. How is everyone? Can anyone speak? Ken, are you there? Kathy,
I'm here. Can you
Dimitri?
hear me, Don?
Hey, Ken, yeah, I hear you.
How are you?
Good. How are you doing?
Good.
I haven't talked to you since the new year, have I? Couple emails.
Yeah, we're doing that. We've talked a little bit. We're doing that note, that Alexander note.
Yeah, that's right. That's right. So that was good. That took a long time to put together those little deals, but anyway, and thank you for that. I really appreciate you being uh, in with me on that. Anyone else have something they before I just launch off into tonight's topic? Anything you want to? Hey, you have a question about something? A deal you want to talk about? Anything whatsoever? There's chat and question Q&A buttons. Okay, well anyway, you guys know I hope by now how to type in those questions and hopefully by now I know how to answer them. But anyway, this thing tonight that I sometimes all types of deals come to me because of the internet or referrals from other people. And usually when they don't have a solution, this lady came to me. Wow, she's just about ready to lose the deal because here's what happened. She is a tenant in the upstairs. There's a 3-unit building. It's a mixed use. It's a church on the bottom, and it's an apartment at the top where she lives. And then there's a garage, separate building with another apartment on top of that, which she's getting ready to rent to a friend of hers if she could figure this out. So what happened is the owner somehow disappeared in the last 2 years or something and never paid their property taxes. So even though they were paying rent to the owner wasn't paying property taxes. So eventually it went to tax sale, and a big company bought it. Who goes and if you don't know, there's a lot of big money from Wall Street chasing assets that used to be the domain of people like you and me, the small mom and pops. And so now you've got big hedge funds and larger companies coming in and just buying massive amounts of tax liens because everyone's chasing where they get a safe yield. So now all the big Wall Street money, now that they've ruined everything else, they're coming in to buy property and paper and tax liens and other things and compete with like us mom and pop investors, like I said, which means there's less inventory and they're paying way more for it than we can because we actually have to work for our money and we don't get to leverage 2%, or free money from the feds. And some of these funds only have to make 4 or 5% return, whereas just to keep up with inflation, you and I've got to make at least 8 or 9%. So anyway, just interesting commentary on the massive transfer of wealth that keeps sort of coming as they take their syringe and keep coming into these various markets that have normally been our domain. But anyhow, so she's been there like for 20 years, and she goes, I've and so she the company, there's a really nice gal who's the asset manager, or one of them anyway, for this big company who owns the tax deed. And so like 6 months ago, she says she felt bad for the lady, and she says, "Look, I'll sell it to you. I'll sell it to you for, you know, bare bottom of what I think the fair market value is." And she goes, "Well, what is that?" "Okay, I'll sell it to you for $25,000. And the lady and her husband are like, "We don't have $25,000. But they scraped together $5,000 and gave it as an earnest money deposit to the asset manager who's been holding it this whole time. And she gave them 90 days to get the financing in place. And then when they couldn't come up with it, she gave them another, another 60 days. And then she gave him another 30 days. And by the time it came to me, basically the asset manager's like, I'm really sick of this. I'm going to keep their earnest money deposit and I'm just going to, go and find the next buyer who's actually going to close. And I said, hey, I don't, you've done more than what a normal person would do. I don't blame you, but based on what I hear about the property, if you'll give me a little time to do some due diligence, I'm pretty sure I can pull this thing together. And so she agreed to give me, a few days. And anyway, so does it really sound like, oh, am I in the business generally, you people that know me, of making a loan like this? $25,000 purchase price, 5,000 down. Do I want to make a $20,000 loan to someone who lives in a property? No, I don't. But anyway, then my mind goes, I wonder if there's a way that it would make sense. So then I start thinking. The fair market value is all over the place. You've got some, it could be worth as little as 30,000. It could be worth almost 100,000. Okay, so, but I know that it's worth at least what we're bringing to the table, okay, if not a lot more. And it's hard because it's mixed use, right? It's a unique type of property. The hazard insurance just and liability just for 1 year on the whole thing is $3,200. That's got to be paid at escrow. They've already scraped together all the extra money they can right here. This was it. So they don't have money for insurance. Property taxes are due the next installment in March, so that's got to be paid at close. Closing costs are freaking expensive. This is in Illinois. I could not believe it, how much they charge for closing, and for title insurance is like 3 times what I'm used to seeing it. It was just really insane. So basically, not even counting this 5,000 that she's already paid to the asset manager, to close this deal, we have to have 27,900. Okay, so again, what am I thinking? Well, long-term tenant, lots of emotional equity, plus a fair amount of hard equity. Really, on a purchase price of 22,000 or 25,000, not counting all the other fees that go with it. Let me see if I can move this over. 5,000 divided by 25,000. Actually, that's not so bad. 20% down payment. It is a mixed use property, which can be, interesting. But there again, there's long term tenants in all of these. And the combined rents are, whoops, I thought I turned that off. I'm sorry. But anyway, 1,900 a month. I mean, that's pretty strong cash flow for something that you can buy for $25,000. So like, here's what I'm thinking. Well, what if I owned this property? Would it be necessarily be a bad thing? So I'm going 1,900 a month rent, and then times 60%, because I'm just assuming right off the bat that 40% goes to taxes, insurance, and maintenance at a minimum. So I've got $1,140 coming in per month. Then I times 12. That's going to give me $13,680 a year. And divided what we're going to have to bring to the table here. 27,900. Oops. 27,900. So basically, that's a 49% cash on cash return if I end up just owning the property. Does that sound okay? Will that do? That, ostensibly, if there's not some really big thing that, risk that happens, that sometimes does with owning property, that like I can't hurt doing that, right? It doesn't look bad. All right, so then I went back, to the point where I don't want to make a loan. Okay, the consumer loan's a no-no because of Dodd-Frank, right? You can't, even no matter what, you just can't make a loan to a consumer, which is unfortunate. But I guess there's, was a lot of abuse, and the regulators are very proud of themselves, I guess, for changing things up. But and the LTV is too high, right? If I come in with if we talk about what the total all-in price is, that 27.9 plus the 5,000 they already have into it, let's say it's a total purchase price or investment of 32.9, and if I'm bringing in 27.9, that's 85%. That's 20% higher. I mean, if I make a loan the highest I ever do, and that's even high for me, is 65%. I don't want exposure to foreclosure. If this defaults, I don't want to have to go through an expensive litigation that takes a long time and the whole time I'm keeping taxes and insurance going, and I just don't want to deal with that. If there is a default, I want to have the right to evict any non-paying tenants, not have to go through a foreclosure process, because then it might make sense, because like when I'm thinking about my non-performing note counterparts, I like I used to didn't think like this, but after I hear them talk about how they think about deals, it really expanded my ability to be more creative, because emotional equity is huge, especially for those non-performing guys that buy the junior liens that are behind performing first. They're betting on high emotional equity. And so that's in this one. And as far as I know, she has skin in the game, both emotionally and hard cold cash out of their savings account. So, and there's a lot of people buying, not that I would think that I think this is crazy, but there's some of those big funds I was telling you about that's the Wall Street money, that they're coming in and buying non-performing notes at 85% of the UPB. I mean, it's incredulous. No sane investor that has to make a return can do that. I don't know. It's a really crazy manipulated market we have going right now. All right. So what I'm going to decide to do is I'll buy the property and give her an option to buy it back from me. So I had her assign the purchase contract, and just mind you, like every day or every other day, I'm on the phone with the asset manager, and she's like, is this deal really going to close? I'm really so sick of being strung along and strung along. And I said, yeah, I mean, I totally get it. And here's what I'm doing, and here's what I plan to do. And if at the first second I think I'm going to pull out, I'll let you know, and I won't string you along. And so there was a lot of sort of time pressure to put all this together, although you have to do your due diligence. You can't really go faster than you can. So I don't want to take title. You never take title to property in your own personal name. That's just a given. You never do that. And none of you are ever going to do that ever again. It's part of just privacy. It's just an important thing to do in the world of contingency fee lawyers and hungry Uncle Sam tax agents. So it's just and all sorts of things. It's just a better idea always to have that layer of privacy. So, and because it looks good, I the name of the trust is the name of the church that occupies that downstairs unit. So anyone's like, oh, well, you don't want to sue a church. I mean, it just makes it look, right? It's just the title that will cause the least suspicion of anyone. Okay, so we just picked that because I thought, well, why not? Then I'm going to give the tenant an option for the $5,000 she already gave like 6 months ago. Plus, I'm going to ask her to bring another $1,500 to the table to close. This I put in my pocket just for the mountain of paperwork, then bending over backward to put it together really quickly. So $6,500 total is her option fee, and she gets the right to not buy back, but to buy the beneficial interest in the trust from me at any time according to an amortization schedule that starts at $38,000, and we'll talk about that number. So basically, for $6,500, she has the right anytime in the next 7 years to buy the property. Buy the beneficial interest in the trust that owns the property for $38,000, or the unamortized balance at that point in time. Does that make sense? Any comments, questions?
So she has to come up with that 38,000 then, Don?
Nope. All she has to come up with is another 1,500 to close.
No, but I'm talking about if she wants to buy your interest in the trust, doesn't she has to come up with the full
Yeah,
amount at
like if
that point?
tomorrow, if in March next month,
Yeah, in the next 7
yeah,
years.
in March. So I'll show you what that looked like in a second. So just keep that in mind because let me see. I might be getting ahead of myself. Okay, so here's what we did. So now they've got an option to buy the trust, the beneficial interest in the trust, but now we need an occupancy agreement. She needs to have a master lease agreement for that entire mixed use property. What can they afford, right? I don't want them to default. I don't. I mean, not that 49% cash on cash return is a bad thing, but I really, to me, the proper use of private money in the ideal world is to enable people in a fair way, given risk reward, to be able to accomplish something they couldn't do otherwise. I want this lady. She and her husband are an older couple. They've been renting for the last 20 years in the same property. They love it. They have family. I want them to own it and to have a chance to build financial security for themselves. I want them to. I don't want them to be like it. I mean, I just get impassioned by these ideas. Like, I don't want them to be counting on a social security check or some other government subsidy, and eating cat food when they're 72. I mean, these are the little stories I make up to myself, but this is why these have meanings. Like, I really want them to have a chance to own a property because, wow, once they get me paid out and out of the way, they're going to have really, really nice passive positive cash flow that will completely transform their retirement. I'm sure of it. And their retirement picture at this point. Okay, so the rent from the other two tenants, not including them, and they've been paying $700 a month, but the other two tenants bring in $1,300. So really, to make the $1,500 a month, they only have to pay $200, which leaves them $500 a month to make repairs. Does that make sense? So they said this is an easy number for them to make, and they could commit to that. And I told them, if you mess up, your all your deposit money isn't coming back to you, and you'll just be a tenant again. And she goes, yes, I understand. So do you still want to do it? You still want to do it? Okay, yes. The closing costs got higher than I expected. Do you still want to do the deal? Are you sure? Yes, yes, please. You're our last hope. So anyway, taxes and insurance are expensive. $637.50 a month for taxes and insurance. So 1,500 minus taxes and insurance. This is what's left over, $862.50, which now I'm going to make that their monthly rent or lease payment. And so what I've got into it, right? Did I already say that? It was 27.9 to close, right? Oops. 27.9 to close. So I'm in it at about $28,000. Well, I need to be paid. Not all. I need to be paid for this risk I'm taking, and it's a lot of work for a small deal, right? So I'm like, I'm gonna need $10,000. I mean, I just made up that number. You can make up any number. I just said, you know what? I am for the risk I'm taking and everything else and all the freaking moving pieces that I had to put together in short order. I said, I'm going to sell it back to you for 10,000 more than we're in it, cash out of pocket. And then even from there, I said, I'm going to start with that whole amount. And really, I'm looking for 20% on this. I don't know if that makes me bad or not, but like for me, on this, that's what I just sort of put in. 862.50 is what they can afford. So I put that in an amortization like it's a loan. And then I came up with 80, and then I go, well, let's just make it around 84. So basically, I'm making almost a 21% yield in the perfect world of everything goes according to plan, which usually there's hiccups of one kind or another, right? You never can tell. But on paper, it looks like it's not 49% cash on cash, but it's a nice 20 something passive return, helping a nice older couple. I think they're nice. You know, create some long-term financial stability and passive income in their life. So then, well, I don't want to put all that money out of my own pocket, just me. So I brought in an investor friend who's very comfortable with trusts. In fact, helped look over my shoulder and make sure that, just another set of eyes to see that, it made sense the way I put it all together. And that's kind of nice. And sometimes one of the benefits of partnering with someone who's smarter than you in a certain area is it's like, okay, you bring him in on the deal, but it's kind of like you get a free little seminar out of it. So that, to me, that's like a bonus for doing business with him on this one. And plus, he's only a couple hours away from this collateral, which is another bonus because he could be boots on the ground in a worst case scenario. So to me, it was a match made in heaven. It just so happened he has about 15,000 in one of his self-directed IRAs that he wants to put to work. So, okay, I said, okay, basically, I'm not going to give you 50-50, but I'm going to give you an 18% yield. So here's your 15,000 you're going to put in. Going to give you an 18% yield. And he was like super happy with that. I think one of the other deals we did, he got 9 or something, and he was happy with that. So he's very happy with this, and he liked the numbers, and he co-signed everything. Then 84. So if he puts in 15, needs an 18% return over the next 84 payments, how much does he need each month? He only needs 315.27. So I wonder what percentage of the deal it is. So I take 315.27, divide by the overall payment coming in, and I get 37%. So when we put the trust together, we're both beneficiaries, and he's a 37% owner of the trust that owns the property, and I'm 63. So that's how I sort of figured that. And he goes, anyway, never mind. All right. So then what does that mean for me? What do I keep? Well, I'm going to collect the whole 1,500 every month and make sure taxes and insurance get paid, right? I don't want that to be a problem. Out of the 862.50, I owe him 315.27. Not that I can guarantee, you can never guarantee anyone a return. This is just a projected yield based on the investment going exactly according to the paperwork, right? Which rarely ever happens. Just once in a while it does. So what's left over that's not taxes and insurance or what I owe my partner is 547.23. Oops, gosh. 723. So I make that a negative number and I stick it in my little payment. That's the money that's going to come into me. We know that it's 84 months, starting with 3/1, March 1st. How much do I have to bring in? The total to close is 27.9, and my partner is bringing in 15,000. So I need to bring in 12.9. So I wonder what my yield would be. Okay, well, that's pretty much that cash on cash return as if I was an owner. So I don't know. That's the story for today. Any comments, questions, concerns? Yeah,
I got a couple questions for you, Don.
yeah.
This is Ken. As far as the land trust goes, are you guys considered real estate owners or note promissory note
We
owners on this deal?
we have personal property, which is the beneficial interest and power of direction of the trust that owns the property. But nowhere in the name or in public record will you find our names or our entity names. But we're
Right, but I mean, is the deal a promissory note
no,
deal or a
you
real
know what?
estate deal?
In practice, oh, I was going to show you this just to show the amortization, because you asked what happens if they're going to be paying you 1,500 a month. So I just put this into T value, right, at 38,000, and And then I said, this is how much they can pay over 84 months. And so I told them at any point, it's like having a rental payment that part of it goes to reduce the outstanding balance. In this case, it looks and functions exactly like a mortgage, but technically, this is not a loan against the property. This is an installment sale, a that we're selling them on terms the beneficial interest in the trust, which is personal property. So at any point, like,
Okay, so the IRA, how would you present this if this is this going to
no,
be in your
I'm
IRA
doing
too or
it with
just
my
his?
regular money, and he's doing it with his. That way, I can manage this thing and service the note. Otherwise, I can't because I'm a disqualified party to my own account.
Yeah. Okay, so then if he's got it in his IRA, how will you do the paperwork towards his IRA? Because they're going to want to see either a contract of sale or a promissory note. So which one are you going to
Yeah.
send the IRA?
Right. Yeah. So it's like a contract. It's like we're buying the property
Okay.
basically. So it is we own real estate at this point, and we own the real estate. So he's hoping and crossing his fingers that all he's got to do is show the purchase contract and show the trust agreement, and the
Okay, now if he owns the real estate in his IRA, because it is considered real estate, then keep in mind that he's going to have to make a percentage of that tax payment from his IRA funds when the tax bill is due.
you know I'll have to ask him about that because he says, well, because the way he's done these deals for years
Is
is,
that Randy you're talking about?
yeah, but I wasn't gonna use his name out loud.
Well, I just gave him his first name, so no one has to know his last name, right?
Yeah, I mean, he's the one that taught me all about this. So in his, I wonder what he would say because technically he would say it's personal property. He would say it's just the beneficial interest in the trust.
Yeah. I mean, you might just want
No,
to check that out
I
only
think that's
because
a
the fact
great
that
point that I didn't think of. So thank you very much. I'm actually going to write that down. Lucky I hold these calls so I can be educated about things.
and also too, Don, on the amount of the transaction fee, the 38,000. If it's just an arbitrary figure from you, why does the transaction fee have to be 38,000? Why can't it be anything less than that? Because you're really making the deal whatever you want to make the deal, right?
Right. I can make it less, I can make it more.
Because why do you guys need to come up with more money? If you make it more, can't you have a somewhere in there like some type of an exit fee or an option fee for that extra 10,000? Because the more money that you make it, the more money that you have to put in. Wouldn't it be beneficial to do some kind of leveraging in this deal in his IRA and just for you as well to not make it so high?
Well, the
Because in the end, if the lady buys it, she can still buy it for the 38,000, but then you would get maybe a an option fee of 10,000, and instead of making it 38,000, you would make it 28, where you would have to come up with less money, but maybe still get paid on the amortization if it was maybe possibly a higher amount. I don't know. I'm
Yeah,
just I'm
no.
just
Well, actually, the money we have to bring to the table is the exact same no matter what. But I think it's a good point. What you're saying is instead of amortizing this 38,000 completely down, I could have said 30,000 or 28,000, and then say, but your
Mhm.
exit fee's an extra 10 grand. But I know she's not going to come up with that in 1 month anyway. So, but I mean, the most we're bringing to the table is 28,000 between the two of us. It's just like how do
Mhm.
we figure in our profit at each? So
Mhm.
basically, she's paying her $10,000 up markup a little bit at a time every month. You
Right.
know,
Who manages this building?
well, she's going to be managing it, so she's going to be collecting the rent. So she'll have like a master lease.
Who manages it right now?
Nobody.
Who's the
You
manager
know, that's
currently?
a really, I don't think anyone's been paying rent or something because, oh, probably they've been paying the asset manager, was what I'm guessing, because they own the building.
Because if you look at some of those if you look at some of the numbers that you're talking about, Don, $300+ for insurance is almost outrageous a month for a building that might be worth thirty thousand
That's
dollars.
what I
You're going to be
thought.
paid $3,600.
That's what I thought. It was,
So I would check on that first of all. I would call someone. I would call some insurance people on that one there. That
You
seems way too high
you
for that. Now,
you have
because it's a church, maybe there's some
Well,
liability.
it's mixed use for one thing. So then you've got the public coming in and out. I'm sure that's a big part of the liability
Hmm.
issue. But the
Yeah.
other thing is, I mean, I even verified this with my partner. I go, "What is it with you people over there?" And he goes, "Yeah, it's really expensive." I mean, literally, the owner's title policy was probably 2 to 3 times what I would pay in California for the same thing, if not more. And then the closing costs too. I mean, holy cow. I mean, I was just shocked. And apparently, they just in this county, they raised taxes again. So and everybody's going, choking under the weight of property taxes. It's
Yeah, this is in Illinois,
yeah,
right?
Chicago area.
Yeah, it's very high there.
Yeah, so I was just flabbergasted. In fact, one of the reasons that slowed us down is I spent 3 days shopping prices for title insurance, for closing costs, because like I'm
Hmm.
going, I want to give this lady the best deal possible, and I want to come in with as little money possible to help this solution come together. But it was kind of tricky, you know. There's a lot of moving pieces, and like this taxable stuff, and with the IRA, I didn't even think of that. Like that was a down the road, and I guess I sort of expected him to know what he's going to need in his IRA because he's been down this road like several years before I've started on it, you know. So, but I'll ask him
Yeah.
about that. I'll ask him how he handles
Yeah,
that
yeah, because if he owns a certain,
when it's a
yeah, because if he
beneficial
owns a
interest.
certain, yeah, if he owns a certain percentage in his IRA, he's going to have to pay like certain things. I mean, anything that has an expense with that building, whether it be taxes, insurance, whatever, it's supposed to come out of his IRA.
Yeah, that's a good point. So I'll ask him how he handles that, because like he's the one that this is how he buys and sells property all the time. He buys and sells the beneficial interest in trusts. He never buys and sells real
Yeah.
estate per se. He always buys and sells the
Yeah.
beneficial interest. So it's just a really different hat to try to put on, and then you try to throw in self-directed IRAs and all their rules at the same time too. It gets to be quite a menagerie. But the bottom line is, I think of this lady and her husband, and I can see that there's, in my mind, it makes sensible underwriting, risk reward. It's expensive for them, and I told them this is expensive for you. Are you sure you can't find someone? No, we're about to lose this deal and then we'll never have a chance to own it again. And the next owner will probably kick us out. Who knows if they'll kick us out? They're just really anxious. And I don't know, I
Hmm.
find meaning in saying, how can private money solutions get creative and create an outcome that I would
Yeah.
want for these people? So,
Since you're putting obviously some time and effort into this transaction, Don, have you got a person, an appraiser, to go out there and appraise this building,
yeah, I mean, uh,
and or a building inspection as well? I
yeah,
mean, who knows if the roof is going to fall off next week?
that's part of the risk. That was part of the risk that just moving fast that I put on the table, and so was my friend. So I said, "Here's the deal. Should we go for it or not?" Yeah, maybe something really big does happen. I don't know, but we paid that primo Cadillac price, for the insurance. I don't know. I hope it covers something. But yeah, you know what? There's risk. There is risk in every direction. It's just like, for am I willing to do it? Does it sort of make sense? And for some people, they go, no way. And other people say all day long. So, Kathy, you were saying unless it's structured as a note. Yeah, but if I structure it as a note, then it's kind of like, well, that's the loan thing that I wanted to stay away from. Dodd-Frank and all the consumer loan things and usury and all that kind of thing. Because here's the deal. She just didn't need a $20,000 loan. She needed all the closing costs brought to the table, less $1,500. I mean, it was interesting. Is that what you mean? Oh, your IRA partner. Oh, yeah. You know what? We could have. Oh, yeah. So you're saying his IRA could have been just given me a loan secured by. That's a good idea. I didn't think of that. A loan secured by. by the property. He would have been a mortgage holder on there. Add another $500 for lender's title policy, and then, but that would have simplified it for his IRA. But also, part of the deal is he wants the upside, because if this pays off early, our yield's going to be higher. And even potentially, he's willing to take his lumps with the downside too, but potentially, what if it does turn into we get the property, we fix it up, and we flip it? So he wanted in on the equity participation, but I could have worked that way too, right? An equity participation note. That could have been, that's a good idea. That's the way you do it. Because I don't, Kathy, she's from, is it North or South Carolina? I forgot. Kathy, South Carolina. That's because I don't want property in the IRA. You could also have had an equity participation in the note. Yes. Yeah, good point. I'm gonna have to ask him about that, because that's where I'm not sure if the IRA treats the beneficial interest as personal property instead of real property. But I totally get that. That's a really great thought. I'm really glad you guys brought this up. So just for the benefit of everyone else, it's like, instead of owning property in your IRA is not as ideal as owning a note, right? It's more complicated, more risk, sometimes subject to UBIT, unrelated business income tax if you have any leverage. So it just keeps it simple. Yeah, the expenses don't have to come out. I like that. That's fantastic. And I wish you could get a mic so you could talk to us. Sometimes I miss hearing your voice on the call. That's your next assignment, is to get a mic so you could speak on these calls. But yeah, someday, if your investment go well enough, you can buy a $20 mic. Yeah. All right. Well, any other comments or questions? I really, really appreciate this brainstorm. I love this kind of exercise, and yeah. But all right. Well, thank you so much. I appreciate you guys, and I will talk to you next time. Oh, by the way, just I'm going to be in San Diego. I'm not going to do too many speaking gigs running around the country like a wild, crazy person like I did last year. But I'm going to be in San Diego at the Note Investor Summit, which is the 25th to 28th, I think, or 29th. So if you guys are around or want to do, I mean, there's a lot of great education and networking if you're still trying to say, hey, I want more connections with more people, buyers and sellers of notes. So anyway, just a heads up. But all right, well, you guys have a great night. Thanks so much for spending some of it with me. I appreciate it. Take care, guys.
Go ahead, Don.
Good night. Thanks, Ken.